This is the Self Storage Podcast, where we share the knowledge and skills from the industry's leading investors, developers, and operators to help you launch and grow your self-storage business. I'm your host, Scott Meyers, and over the past 16 years, we have acquired, developed, converted, and syndicated over 2 million square feet of self-storage nationwide with the help of my incredible team at selfstorageinvesting.com, who has helped thousands of people achieve greatness in self-storage. Hello, everyone, and welcome back to the Self Storage Podcast. I'm your host, Scott Meyers, and today's guest is my good friend, Eddie Speed. Now, Eddie and I met through a mutual friend, and he and I really hit it off as we share the same approach to investing in real estate, which is for the long haul. And what has impressed me the most about Eddie is that he knows how to creatively architect a real estate deal like nobody else. And over his 40-year career in real estate, he has purchased more than 40,000 real estate notes personally, and his NoteSchool executive team has bought over $3.5 billion in notes. And as a teacher of all aspects of real estate notes, his methods have earned him multiple industry awards and an inaugural induction into the Small Business Real Estate Hall of Fame. He speaks at events all across the country, teaching people how to find freedom and flexibility through a widely untapped and extremely profitable area of real estate investing, which is creatively buying and selling notes. But at his core, Eddie is a problem solver. He is skilled at identifying roadblocks most investors couldn't work around and at finding solutions to creatively close in a way that's exponentially profitable. And in 2003, he founded NoteSchool, a real estate coaching program that teaches students to buy and sell performing and non-performing notes, as well as other alternative purchasing strategies like seller financing. And over the past decade, he has helped countless investors expand their portfolios by using his out-of-the-box techniques, some of which he's going to share on our call. So without further ado, I would like to dive into my interview with my good friend, Eddie Speed. Eddie, welcome to the show.
Thank you, Scott. How are you, sir?
Doing fantastic, and glad that we were finally able to make this happen. We've been talking about it for several months now, but just appreciate your time today.
Well, same here, and I'm so glad we could make the schedule work.
Well, Eddie, I gave everybody in the intro a little background on you and your bio, but if you would, why don't you tell us how you got involved and started in real estate to begin with, and just kind of fill in the gaps?
Well, I started, by accident. My wife, Martha, and her dad is really the one that got me started in the business. He was an old multifamily guy, did trailer parks and multifamily and houses and stuff. And he was a fireman in Hattiesburg, Mississippi. And so when I met him, he had retired from the fire department. And so he was buying seller finance notes. This was in 1980. Interest rates were 20%. A lot of people were carrying seller financing. So his understanding of real estate and understanding of why somebody would do non-bank financing made him a good candidate to kind of step off into this business. But he stayed in commercial real estate till the day he died. He also owned income producing properties and stuff like that. So my culture was not just a note guy, but it was kind of tying notes in with other real estate strategies and stuff. And I had no experience whatsoever. I was 20 years old. I was clueless. And I would say honestly, and I say this in training a lot, but it's just the doggone truth. He looked for one thing. He knew I wasn't brilliant, right? He had no idea if I could ever be successful doing it, but he gave me a little bit of a thread to see if I was going to grab it. And that was, he was smart enough to know he was looking for an action taker. And that's what he saw. And somehow or another, I fell in love with the business. And when you have a passion for it, you probably can do things that otherwise you're not capable of. Mm-hmm. It's been a journey.
Well, you and I have had many conversations over the many years that we've known each other. And I've always been intrigued by, the way that you're able to look at any type of a deal, if you will, or even an opportunity that somebody is looking at, and maybe they're struggling with how to put it together to get it across the finish line, or, it has to be a deal to begin with, but usually it's in, rates and terms and the capital stack. And you are just an absolute master at helping people to understand and simplify that. And so, that's what I wanted to talk about today and bring you on, is to talk about, looking at different types of terms and seller financing and creating that capital stack. Could you, tell us a little bit about, the many ways that people can at least explore this, and then, perhaps an example. I think one of those that we talked about before is a self-storage deal that you helped someone with, and maybe we delve into that a little bit.
Well, there's a combination of things that make us creative, right? There maybe is a personality type that is a little more in the area of liking to be creative, and I think I probably fit that mold. But before you can ever be creative, you don't know if you've got a gut feeling of a great idea or bad pizza, and if you don't have a base of knowledge, right? So one thing that's influenced me is, gosh, I've looked at 3 or 400,000 seller finance notes. So people have shown up at my doorstep trying to sell us a note, and they have their deal is becomes evidence to us. It's kind of like the creative attorney or the real estate specialist attorney or the real estate specialist accountant, and he gets to go do accounting for, you know, hundreds of real estate investors, like a Marcus, right? All of a sudden, his vantage point of different ways to do it becomes different. And that was my unique perspective. I set up the note system for home investors in 1991 or two, right? The guy that founded Home Investors, Ken D'Angelo, came to me and says, we want to do a franchise to buy houses, but we think we've got to have creative financing or seller financing as part of the business. And so I've gotten to work with hundreds of real estate investors on all kind of asset classes. So that is where you start. I've started in the business from understanding of seeing so many deals and how they structured them and what's possible. So most people do a couple of things when you say creative financing or seller financing. You and I have been around a certain group of people that like, oh yeah, I get this. What you do is you offer 0% financing on a 10-year term, blah, blah. And to me, that's a very generic way of doing it. I'm not saying it's terrible, but the odds of your customer agreeing to it are fairly low, right? So you have to then figure out, like, what is the purpose in pasting on creative financing on top of your normal deal? Well, it probably means this. It probably means the lender has a restriction. The seller has a price point that you as the operator think can't work. And so those are essential reasons that creative financing is required. It's not optional. You have to do it. But then you start figuring out, whoa, whoa, whoa. I was forced to do creative financing on this deal. On this deal, I have the option, and I'm way to structure it, and I can structure it in such a way that all of a sudden it's a way better deal for me. So I've learned that if you took 1,000 property sellers, and I don't really care if they're like sophisticated guys selling storage units or an unsophisticated person selling a single family house, right? Most people, if you get to their core, what is really their hot button, it's what it says on the closing statement. Like, they have a price and they want to get to that number, and that's their thing. And they will give up a lot of things to get to that price. It's why they don't want to sell at a discount, right? So I've learned that if you find that customer, they have for some reason a real estate problem, right? Something about the deal says they have a real estate problem, or maybe it's just time for them to move to the next property and move their equity on, or whatever it may be, right? But for some reason they want to move from that property, but they look at you and they say, well, I'm not that motivated, meaning that they don't want to sell at a discount, right? So if you can get to that conversation with them, you're like, if I can pay for part of your equity over time, I can get to the price we need to get, right? Now, think about that. What I just said was, if I can pay you with tomorrow's dollars and get today's price for the property, I probably can figure out how to make a deal. So that's kind of a good framework, I think, to start this. Like, what is this, right? How does it work?
Mm-hmm. Absolutely. And again, as we discuss and we look at these deals, whether all people involved, from the seller to our lenders and sometimes our equity partners, if we're at an impasse, and with the commercial brokers, it really is just a math equation. And just trying to figure it out, unless there isn't a deal there and we find something glaring that comes out later. But, if we know that we got a deal and now we just got to find a way to get to the finish line, or if we're just at a sticking point, it all just becomes about the math. And the math means so many things in terms of not just the amount, but the amount over time and interest rates and the true cost of the capital. So yeah, with that, you've explored clearly many more ways and looking at many more opportunities and seeing the solutions on the back end than we have. So yeah, carry on, Professor. Show us some of the ways. Tell us a couple of things that we can take a look at in our next projects that we may coming to an impasse on.
Well, the one thing that I've learned is I have to get past people's limiting beliefs, right? When we look at seller financing and we look at $100 million of people that seller finance properties, we have a pattern in our mind. A typical real estate investor that doesn't have a note buying shop and buy that many notes, they don't know what that pattern is. We have an advantage. We know what the pattern is. Average interest rate on all seller financing is 4%. It's not 8. People think it is, but it's not, right? The average interest rate, 1/3 of people that seller finance carry it at 3% interest or less. Now, everybody thinks that I'm always going to get the seller to agree to 0% interest. And that is true about 18% of the time. It's okay. So understanding, now I'm looking at how people that offer seller financing and what people that agree to seller financing, I'm looking into the pattern. So I start then understanding, and like, there's always the outlier, right? There's always some guy that's a tough negotiator. It's not going to agree to what's normal or what it, but now I start to understand what's normal in the person's mind that agrees to seller financing, right? Okay. So Eddie, give me a punchline. Okay. What I've learned is this: most people will offer seller financing and they want a fairly short-term maturity. They want a short maturity, meaning they want the loan to pay off in 5 to 10 years. That is, Scott, to you getting the seller financing, that is not to your advantage. That's to your disadvantage. Because if you have a balloon, that means you got to go recapitalize or have a capital call or something and go re-raise the money, right? Or you got to go refi. Well, if you're doing a piggyback second, how are you going to refi behind a $4 million first and you're trying to refi $500,000 second, right? The math that isn't good, right? So all of those things mean that I've got to get that customer to get past the I'll do it, but. What I have to do is get that customer to say, I'll do it. And they're not really going to say this, but they're going to say it by the way they're willing to agree to it. I'm willing, Scott, to do it and to do it on the terms you're dictating. So here's some things I've learned. There's a greed gland in people. You know what I'm saying? And if I know how to hit that greed gland, I can get them to agree to something that's to my advantage, but they want to do it because I'm going to give them exactly what they want. So let me tell you the simplest thing I've learned to extend the term and get them to really be fired up about extending the term. And that is, I'm going to pay them more interest than they asked for. You're like, well, I thought you said this was a bargain. It is. Because what I'm going to do is get them to agree to no or low interest as a start rate. And I'm going to amortize down what I owe. And then I can start stepping the rate up. I could go to a 1, to a 3, to a 5, right? But by the time I'm paying 3% interest, the payment is lower than it would have been if it normally would have been, because now I'm paying off the loan at a higher interest rate, but I've already amortized on the front end the loan amount I owe to where my payment is inordinately lower than normal. And then the ridiculous side. Now, oh, Eddie, now you've agreed to 5% interest, and they didn't even want 5%. They would have taken 4%. Yes, but I'm paying 5% on excessively less principal. And now I've taken what would have been a 20-year AM and an 8-year balloon. Now I've taken it to a full 20-year AM. And I don't have to go recapitalize. I don't have to cut the deal. Oh, and Scott, if I take a note over 20 years and I bake in the right terms in that note as the borrower, something a bank's not going to let me do, but an individual seller financing will. One of those terms, and there's many, but one of those terms is going to mean that I'm never going to pay the loan off at what the original debt was written at. Why? Because trust me, they'll wake up in year 6 or year 8 or year 12, and I'll buy my own note at a discount. The deal after the deal. So I don't know what day that is. I just know that day's going to happen. And so all of those variables, now you can see that we have structured a deal that I paid them the price they want. I figured out they're willing to let me dictate terms as the borrower that really a bank or a mortgage lender won't agree to. I know they won't agree to it, but an individual will. If I give them the price they want, and then I figured out a way to get past the biggest monster, which is, okay, I'll do temporary seller financing. I'll seller finance you for a period of time, but then I want to balloon stuff. And you can imagine doing a capital structure. Like, how are you going to put an 8-year balloon? You're going to go raise another $500,000 from your guys in 8 years? They're not going to like that deal, right? So you can just say with integrity, I can't agree to that. Let's figure out what we can both agree to.
And at the end of the day, that is, I think, probably the biggest takeaway and the key for anyone here listening is that a deal doesn't die if it's a good deal. You'll find a way to fund it, and whether that's bringing in capital from private equity or mezzanine lenders. If you can't get it done up front, well, our first stop is always with the seller, and I'll ask them repeatedly up until a weeks before closing. Are you sure you don't want to? Are you sure you don't want to defer your capital gains and still get money for the property without owning it and having a piece of something all the way on through? And then again, it's just a matter of really showing them, the ways that work in your favor and the reasons why. And to your point as well, Eddie, we've seen so many times, and I think people still, and maybe some on this call, that recognize or think that the only way that somebody's going to offer seller financing is because they've got a dog of a property that, the appraisal didn't come in, or they were backwards on the valuation of it, or they didn't have enough records that the bank wouldn't finance it. And that's not really the case. We lead with seller financing because that changes the dynamics of the deal. And again, going back to my analogy, and that is, it is a math equation. But to your point, Eddie, you're showing us ways that you can make this totally work in your favor and somehow turn this deal into a more favorable deal just by being able to sit down with the seller and making them realize and coming to mostly their terms. Does that make sense? Is that fair?
Yeah, it moves us out of a buy low, sell high mindset, right? A commercial guy like you're not like a house flipper, buy low, sell high. You're thinking in terms of a value buy up front and structuring your financing to where you've got a long-term income and hopefully a lift at the end, right? Right. I mean, that's so you're not a short-term thinker. So think in terms of the creative financing piece are the ways to give the customer what he really wants. Like we all of us have been at the negotiation table a zillion times, right? The customer wants everything. They want price. They want it closed in a week. They want, we already know their want list, but on every deal, we have to then work with them to prioritize what their real level of priorities really is. Right. And so when people say, I don't want to carry terms, then you would be at a point where it's like, well, let's talk about what's your objection to carrying terms? Okay. Well, what do they say? I want all my cash today. Right. Okay. And you say, well, okay, what if you could take a portion of your equity? That could be 80% or 20%, right? What if you took a portion of your equity? And what if I could pay you more for your equity if you let me pay it over time? Would that be of interest? You see what I'm saying? So now all of a sudden, what you just did is you allowed them to start in their mind, not in your mind, but in their mind, they started prioritizing what was important to them. So I always say there's half of the deal, right? I love structuring deals, and you know this, right? I mean, I practice it a lot. I probably practice it more than anybody in the country. So I can come up with fairly creative stuff sometimes because I just do it a lot, right? And I've already figured out other combinations. So I figured out I can apply. I look at them as puzzle pieces, right? And I can take a puzzle piece that I've applied on another scenario and apply it to this deal. And I just described that like a step rate.
Mm-hmm.
Okay. But go back to the other idea, which is the talk off, the negotiation process, right? And we all know that even if you're dealing with a really sophisticated guy, he can't really drive. He doesn't know what's important to him. He thinks he knows what's important to him. He wants 20 things all at one time. And he doesn't really prioritize his level of importance. You agree with that? I mean, he just hasn't really thought about it that degree.
Yeah. I agree with that 100%. And the way to get him open to that, or her, what I found, Eddie, is as you're saying this, I'm going through the conversations we've had over the years, and when we get that initial resistance to, I want all my cash at the same time, and I say, really? Well, why is that? And because most of the people we buy properties from and make them think that they're in the minority, and that, hey, all the cool kids are doing it, you should be open to what I'm about to say over the next 5 minutes, and at least get that barrier down, those defenses down, to have them be open to that. But that's just an aside. So carry on.
Well, and once again, I mean, this sounds a little bit corny, but I can tell you it will work on $100 million deal, or it'll work on any level of a deal, right? It may sound a little bit corny, but it's absolutely true. And that is this: who makes the most money in their business? What's the most profitable entity in a car dealership? Their finance department.
Mm-hmm.
What's the most profitable entity in a furniture store? Their finance department, right? So you start giving people examples of other businesses that do that. And then a guy you see him start sort of swelling up, like, yeah, that's what I want to be. I want to be the multi income stream operator. You see what I'm saying? And as corny as that sounds, it is a heck of a good psychological approach.
Mm-hmm. Yep. I've heard it said once before, and I've used this a couple of times, and that is, who owns the tallest buildings in any metropolitan area that you go into?
Yeah.
And if they guess it, it's the banks. And if not, I'll tell them it's the banks. And why is that? It's because they finance things. So don't you think that that's a good way to be able to make money in real estate and to have the biggest buildings, and that begin to get them thinking in those terms?
Well, yeah, the furniture store carries payments over time because they figured out it's a way for them to sell furniture at a price their competitors can't sell it at. And of course, everybody knows that. It's not like they're like, really? That's an odd concept. So then all of a sudden, then you're sort of invoking in their mind. And I do all of that to really get them to break down, like help them establish their priority list. And then once again, the concept is the Zig Ziglar thing. You give people what they want, right? And then you get what you want, right? So all of a sudden, once you do that, then you've now taken that list of they want all 20 things simultaneously. Now they've established these 3 things are way more important than the other 17 things that I want up front. And then all of a sudden, then you get, I've met a lot of people that try to, buy on terms, and they can come up with really crazy stuff.
Mm-hmm.
But the truth of the matter is they're playing the sandbox by themselves.
Mm-hmm.
And so you got to always think in terms of what makes the guy want to play in the sandbox with me.
Mm-hmm. So let's take I know there's no such thing as an average or a typical, but maybe, of those 20 things that the seller wants that you're able to give and structure something, walk us through what that might look like and how you've been able to put together either as one of your self-storage deals or a particular commercial piece of property, just so the folks can maybe get an idea or understand what some of these tools are and how to layer them into a project.
So they want their cash today, right? Mm-hmm. They all want their cash today, right? But you brought up a good point. Whoa. What if the structuring financing could give you a tax advantage, right? Now you of course going to do the disclaimer that you're not giving tax advice and all that good stuff. And, but it's a true thing, right? And it really could help them. So to defer taxes over time. So that's a good possibility. And then the other thing is, at the end of the day, all of us have been to thousands of real estate events, seminars, conventions, real estate meetups, masterminds. We've all been at these things. And what do we tend to do is we sit around in the little coffee shop or at the bar, and we're sitting there and we're telling our best real estate story. And this just happened to us, right? And this just shows you how human nature is. And so everybody gives you the buy low, sell high story. Now, they may have bought it today and sold it tomorrow, but it's always the buy low, sell high story. It's never about the crazy terms. It's always about the price. So it just shows you, like, when you watch human nature, this is how people are wired. And so I've learned that if you can focus on their big thing, which is price, and sometimes it's even the renegotiation. I was telling you this story before we started about a mutual friend of ours, and I coached them through a storage unit deal, and it was only 10%, right? The price was $4.5 million. They did $4 million mortgage. They ran due diligence, and some of the guys' numbers weren't going to stick, and so the lender was going to back up and in the loan they were willing to make, and so they needed a $500,000 price reduction. And the seller basically was going to punt, and so they said, "Okay, would you carry terms?" And so then this is fairly normal in a sophisticated seller. The seller then gave them 3 options of terms, all of which had an 8-year balloon, right? And I said, "Okay, so those options were 3% interest, 4% interest, and one of them he lowered the interest, but he kicked the principal amount owed up another $200,000, right?" So we broke down which was the best deal. And now that I said, but now that you know which one is the best deal, we're not going to agree to any of the 3 of these, right? It's a little bit of the seller kind of showing his cards of how he thinks, right? In other words, I wanted the seller to come up with something, although I knew we wouldn't agree to it, but I wanted him to do it so I could just see how the guy thought, right? And it was fairly interesting of how he did it. Like he would change the rate, but he would increase the amortization term, and he would make tweaks to it. So the idea, what he finally came back with is this. What we finally got him to agree to is this. He wouldn't do 0% interest. Ego or too smart or who knows, right? But he did 2% for 7 years. Then he did 4% for another 7 years. And then he did 5% for the last 6 years. And when I ran the cash flow analysis of my student, his payment was 15% cheaper than it would have ever been for the first 7 years. His payment was almost even for the next 7 years of what the guy wanted. And then the payment was like another 10% higher than what it would have been. But once again, this is years 14 through 20 instead of having an 8-year balloon. And do you know that seller agreed to that like a lay down deal? Like he didn't, it was not a lot of fighting back. You know why? Because he thought he would pitch 3% interest and them agree to 2, or he thought they would pitch 4% interest and they would do the compromise and agree to 3. 5% interest was never even in his formula. And I saw him, a pretty sophisticated seller, completely can change what he would agree to because of that. Oh, but here's another thing. This was actually 2 units, right? There was about 120 units and 220 units. The second lien was only on the 220 units. So he did a release of collateral and released the other units to the seller financing. You see? Or you could do an exchange of collateral. Like you got the right to move the loan from that property to a subsequent property down the road. You see what I'm saying? We know a bank wouldn't agree to all this stuff, but we've figured out that here's the thing. When the deal was fixing to fall apart, the guy was going to fall on the sword over the price, but he still wanted to sell the property. That $500,000 in seller financing was not going to be the sword he was going to fall on.
Yep. After all that, and wow, well, lots of lessons in there, Eddie, and in ways to approach these sellers. But once again, you have to get their buy-in and understand what their triggers are, and taking the time to do so. And I think we always jump to the solution because it's either the only solution that we know, or we think that this has to work for us, or else we're going to walk. And that is not the case. We are. We teach as well, and we teach our folks above all else that, this is a marathon, not a sprint. And, if there's other buyers that have come in, or if you can't strike a deal, there's other buyers that are going to come in after you that are coming in with the same approach. But for those of us that are willing to stick around and, offer, come to an agreement in terms of an offer, counter offer, and be patient with these sellers, even if it takes a little bit longer, we're the ones that are going to win out. And so again, just from the outside, not from a tactical standpoint, just wanted to, come alongside of you and just, the things that I see in these projects is that, if you really want, if it's a good deal, you'll find a way to be able to make it work. And that includes getting creative, or getting, asking questions, structuring things that are appealing to them, but also just having the patience to do so.
Here's another thing. You ever get stuck on a price? Right? I'm talking to the audience. I know we've all been stuck on a price between Scott and I, right? But you get stuck on a price and you're off a little bit. So then the other strategy I've learned, and I teach this to house buyers, I teach it to people doing, multifamily, I teach it to any asset class. It doesn't matter. Land, obviously storage, is do a 0-0. Like, go take a top end of a deal and write it at 0 interest and 0 payments due in 15 years. Now that sounds ridiculous, but you would be floored how many people will take that. Because they told their investors, or they told, like, somehow, some way, like, that price was the thing that they said, oh, I'm going to do that. And you're in due diligence, you're down the road, it's not going to come together. And just, it's a Hail Mary, right? You just go do that piggyback second. That's like the ultimate ridiculous terms. And by the way, if I have some great case studies of people that have tried this, and they always laugh and say, I never dreamed the guy would do it. Now, they always say that every time. The second thing is don't get scared to like make it 15-year maturity. Like you're like instinctively, that's really cool, but you want to put 8 years, or you want to put 10 years. I'm just saying, go for the Hail Mary, give them a 15 years, 0 interest, 0 payment, due in 15 years. And it's a way to not walk away from a deal that otherwise you probably wouldn't have done. And obviously, down the road somewhere, you're probably going to buy the note for 40 cents on the dollar. You just don't know what day.
All good stuff, Eddie. And so here's what I'd like to do. I feel like we need to have a part 2 to this because we're just scratching the surface. But in the interest of both of your time and my time, here's what I'd like to do. We've got, we're going to be heading into a time, and we don't know when. My crystal ball is broken. It's in the shop. We don't know exactly what's going to happen. I guess predicted, if you want to call it that, assuming this recession that we were going to be under would have happened a long time ago, and we keep kicking the can down the road. But what I have seen, and the commercial brokers that we talk to, they've already been reaching out, or they've already been contacted by the banks and the mortgage holders, reaching out to them to say, here's when the free money is going to run out. Here's where we feel somewhere around third, fourth quarter of 2021 is when they're going to begin the process of taking some of these properties back. And they've learned through 2008 that that's a very expensive process if they go through a traditional foreclosure and courts and attorneys. And so what they're doing is they're putting these brokers on notice to say that, hey, there's probably going to be a whole lot of these things coming down the pike. We want you to be ready because we're going to be offering short sales on these in lieu of going into foreclosure. And so we know that there's going to be some time this time around to catch these properties while they're still in the seller's hands, and before they go into receivership or under somebody else's control, where we can begin to utilize, some of the strategies that you're talking about. So I guess more than anything, I want to implore everybody to begin to start thinking and preparing for that time, and ways to be able to do this. And the only way to do that is to as you said at the top of the show, Eddie, is to be around somebody who's done tens of thousands of these types of projects. So with that, where and how can they learn more about ways to be able to structure, and I hesitate to call it creatively, but be prepared to put together what is going to be some fantastic deals, but with some difficult structure, and having that knowledge to be able to take advantage of it. How can they learn more about what you do, Eddie?
So a good way to start is we've written an ebook. Now we refer to houses in the ebook, but I want to tell you something. I've been doing this 40 years and I've dealt with all kind of asset classes. These concepts will work exactly. I just deal with more people that buy houses. The dollars I deal with are probably more on the commercial or land side. So, but anyway, just they're going to go to noteschool.com/get started. It's going to give them two things. It's going to give them an ebook with about 5 chapters. And I'm going to give different analogies in there so people can start kind of like, because it helps people to see what it is. And then as the backside of that, then we're going to put them through a little workshop. Once again, same thing. We're just intensifying, taking up the ladder of what the concepts are. If you decide NoteSchool's a fit for you, we do stuff that we tie in buying notes. We can tie in buying non-performing notes, returning it, selling it out on the other side with creative financing. But this is what we've done for 40 years, is work with all kind of real estate investors. So there's lots of things that can be done. But if we just dump every possibility of somebody up front, it's not going to be a workable thing. So we start them with the terms thing, a real estate investor person, no matter what asset class they're in. And then we'll start working into exits and wraps and all those things as we do. We don't do that necessarily up front, and we don't for a reason that is just too much. So noteschool.com/get started. And it's a solid piece of information.
Fantastic. I appreciate that, Eddie. So let's, if we could, while we wrap up here, I appreciate once again your time, and I appreciate our friendship over several years. You are one of the most creative people that I do know, and not just in terms of real estate, but share, if you would, how do you continue to feed that creative mind of yours? Tell us about a good book you've read recently, or maybe something that you're currently reading that is worthy of sharing with our folks.
Well, unfortunately I have dyslexia. So, I would love to be the guy that read 10 books a month, but I'm not. I'm influenced by a lot of different things. I tell you one thing that is just an old book, but it's a good book, Pitch Anything. And because it just keeps your mind in like what's possible, how to position things, whether you're buying, whether you're selling, whether you're selling a product, or you're buying a piece of real estate, or you're even selling training, or whatever it is. Like, you have to really get into what they see value in. And I believe that's so important. And I'm going to tell you this. Yes, I think God, I'm going to accept the compliment. I think God gave me some creativity, right? But the reason I think I can be so creative is because I love what I do so much. I'm willing to spend the time to go figure out strategies because I just like doing it. It's not work to me. And so I would say to your audience, like, don't be scared to go learn something, right? I'm talking to a lot of people, even really savvy people, and they'll come to do some kind of training we do, and it's like, oh my gosh, that's really cool, but I can't, I can't learn this. Let me tell you what I believe is an absolute fact. In our business, we get paid the most when we're creative. It is the highest paid thing that we do. It's worth learning.
It is, and the old adage, the highest paid vocation in the world, and it's not what some people may be thinking, but it is negotiation, and it is how to pitch things. And I will also give a thumbs up on Pitch Anything, the book, And I would go so far as to say that, many things are sales, but even if you're just trying to sell an idea to your kids or sometimes to your spouse, that book has been helpful for me on a personal level as well as in a business level as well. So absolutely appreciate that. And if you would, one last thing, Eddie, what do you see for 2021? I know there's a lot of swirling around and ideas of where we're headed, and now that it looks like this new administration is in place. What do you foresee in the real estate and commercial real estate realm for 2021?
Well, we're watching it really closely. The only time that commercial assets weren't a big part of a black swan market was the last cycle. It
Mm-hmm.
wasn't near as big a deal, but
Mm-hmm.
I started doing this in 1980, so I've lived through the RTC days. I've lived through, the 2000, the 9/11. I mean, I've lived through a lot of cycles, right?
Mm-hmm.
We definitely think we see the crash coming. Creative financing and all that is going to be, it's not going to be an option. It's going to be an absolute,
Mm-hmm.
right? I
Mm-hmm.
mean, those are how deals are going to get done.
Mm-hmm.
And we're watching it really closely. We have some pretty good ties with guys that do a lot of analytics on the
Mm-hmm.
CMBS assets,
Mm-hmm.
and so we're watching the banks. The big banks this year have gathered up 8 times the amount of loan loss reserves they did for the past 5 years on an annual basis.
Mm-hmm.
So they are bracing up. And by the way, loan loss reserves means they can move assets at a discount.
Mm-hmm.
It's their ability to have already that loss on their books. That means they can sell a defaulted note. That means is they can do a short sale, whatever the case may be. So the banks are bracing up for discount.
Mm-hmm. Mm-hmm.
And so that is I believe you're correct. And what day, it's like, who knows? We've never seen anything like this ever, right?
Right.
So I don't know if it's going to be, March 27th or June 27th, but
Mm-hmm.
it is a crash in slow motion, but it is a crash that's going to happen.
Mm-hmm. Yep. Agreed. Well, Eddie, once again, thanks so much. And one last time, how do people get in touch with you?
Yeah, they're just going to go to noteschool.com/get started. It's going to be a special landing page that I did for you guys on that. So just after noteschool.com, it's just a /sign and it's get started.
Mm-hmm.
Okay.
Well, Eddie, once again, I appreciate you taking out the time and showing our folks other ways and at least to begin thinking about other ways to prepare for how to take advantage of this next cycle that we're going into, but not waiting for that, but doing it now. So as always, good to see you, Eddie.
See you.
All right. Thanks. Take care now.
Yes, sir.
Hey gang, wait, 3 things before you leave. First, don't forget to subscribe to the Self Storage Podcast and turn on your notifications so you never miss another episode. And while you're there, please leave us a 5-star review if you like the show. Second, be sure to share your favorite episodes and more via Instagram, and don't forget to tag us. And lastly, head to the links in the show description and hit the follow and subscribe button on Twitter and Facebook to get a front row seat as we grow and scale our business and bring you along with us. Take care.